Remember, in the world of investing, golden opportunities are rare, and it is our mission to help you seize them. Today, we are exploring a neglected opportunity in the US equity market: mid-cap stocks. While the large cap stocks in the S&P 500 have been shining with a 26% rise in 2023, the mid-cap stocks, as represented by the S&P 400, show a lower increase of 16% in the same period. Now let's look at the bigger picture. Over the last decade, the S&P 500 grew by 212%, outshining the S&P 400's 143%. But there is a key insight: smaller companies have historically outperformed larger ones due to faster profit growth. In fact, during the last decade, mid-caps saw a 150% increase in profits, compared to the S&P 500's 100%. As you can see in chart number 1, higher profit growth and lower market performance seems to be an interesting anomaly and a good investment opportunity. But there is more. When we examine the future growth expectations, both indices are projected to have a similar profit growth rate of 10%. This makes the mid-cap valuation at 15 times earnings particularly attractive, especially against the S&P 500 that is trading at 19 times, a huge 20% discount. As you can see in chart number 2, what is causing this valuation gap? 2 reasons. 1, the S&P 500's significant exposure to the rapidly advancing information technology sector, and 2, substantial inflows into passive ETFs linked to the S&P 500. So what does this mean for you, the investor? Given the undervaluation of mid-caps relative to large caps, with the same expected growth, shifting some investment from large caps to mid-caps could be a wise strategic move. Remember, in the world of investing, golden opportunities are rare, and it is our mission to help you seize them.